When we hear that Moody's has stripped the United States of its coveted AAA credit rating, it's not just a headline or a simple technical downgrade, it's a powerful signal that resonates far beyond the financial world. For decades, the U.S. has held a pristine credit rating, a mark of trust and confidence in its economic strength and fiscal management. This AAA rating has been a badge of honor, symbolizing the belief that the U.S. government is one of the safest borrowers on the planet. Investors, both at home and abroad, have seen American debt as a virtually risk-free asset, allowing the country to borrow at relatively low interest rates. That trust has underpinned not only the U.S. economy, but the global financial system itself, because U.S. Treasury securities are considered the bedrock of international markets. So, when Moody's decided to downgrade this rating, it sent shockwaves through markets and public discourse alike. It's a sign that the agency, after carefully assessing the nation's financial health, believes the U.S. is not as invincible as it once seemed. The downgrade is not just a label. It reflects deep concerns about America's long-term fiscal trajectory and the ability of policymakers to maintain control over the country's mounting debt. Simply put, it is a warning that the financial footing of the world's largest economy may be less stable than assumed. This downgrade matters because credit ratings directly affect the cost of borrowing. A lower rating can lead to higher interest rates on government bonds, increasing the expenses for financing national debt. And when the U.S. government pays more in interest, those costs can cascade, forcing tough choices on spending or taxation elsewhere. It can also erode investor confidence, potentially leading to volatility in financial markets. For everyday Americans, these ripples can translate into higher mortgage rates, more expensive loans, and a tighter economic environment. The downgrade, therefore, is a red flag signaling that the fiscal practices and policies we have relied on for years need serious reassessment. At the heart of this downgrade is a growing and persistent problem: the rising U.S. government debt and fiscal deficits. Over recent years, America's debt has ballooned to levels never seen before in peace times, crossing a staggering $30 trillion mark. This isn't just a number on a spreadsheet. It represents the cumulative borrowing the government has done to cover spending that exceeds its revenue. The fiscal deficit, the gap between what the government spends and what it collects in taxes, has widened dramatically, driven by increased spending on social programs, defense, and more recently, pandemic-related relief measures. Moody's decision is a reflection of serious concerns over whether the U.S. can sustain this level of borrowing without facing severe economic consequences. The agency cited the growing debt burden and rising interest costs as key factors. Essentially, as debt grows, so does the amount of money the government must dedicate to interest payments. This means less room in the budget for other priorities, including investments in infrastructure, education, or even emergency responses. Moreover, the political gridlock in Washington complicates efforts to tackle these fiscal challenges. Partisan disputes over budgets, spending caps, and debt ceilings have delayed critical decisions, undermining confidence in the government's ability to manage its finances responsibly. This political deadlock, combined with unchecked spending, feeds into a vicious cycle that worsens the country's creditworthiness. When policymakers struggle to agree on how to balance the books or reduce deficits, rating agencies and investors take notice. Moody's downgrade essentially signals that the U.S.'s political system is currently falling short in delivering the fiscal discipline needed to maintain economic stability. It's a sobering reminder that managing a nation's economy is not just about numbers. It's about governance, leadership, and the willingness to make difficult choices. Furthermore, this downgrade comes at a delicate time for the U.S. economy. Inflationary pressures, global uncertainties, and shifting geopolitical dynamics already create a fragile environment. Increasing debt levels and a lower credit rating add fuel to the fire, heightening the risk that markets could react negatively, raising borrowing costs not only for the government but also for businesses and consumers. The longer the U.S. delays addressing these issues, the greater the risk of undermining its financial reputation and triggering broader economic instability. In understanding this, it becomes clear why Moody's downgrade is more than just a financial assessment. It's a wake-up call. It demands attention to the fundamental challenge of balancing economic growth with fiscal responsibility. Without decisive action to rein in debt and restore budgetary balance, the U.S. could face consequences that affect every sector of society. This is not just about credit scores or bond yields. It's about ensuring that America's economic future remains secure for generations to come. The downgrade of the United States credit rating is not merely a label or a technical footnote in financial reports. It carries real-world implications that can affect everyone, from the largest corporations to ordinary families trying to make ends meet. When a country like the U.S. loses its top credit rating, it risks higher borrowing costs because lenders will want to be compensated for what they perceive as increased risk. This means that the government will have to pay more interest on the money it borrows, which in turn can lead to a rise in interest rates across the board. Higher interest rates impact mortgages, car loans, and credit cards, making it more expensive for Americans to borrow money for homes, cars, education, or even day-to-day expenses. Beyond the immediate financial effects, the downgrade could unsettle investors globally. U.S. Treasury bonds have long been considered a safe haven, a stable, reliable investment in times of uncertainty. Many financial institutions, pension funds, and even foreign governments hold vast quantities of these bonds. If confidence in the U.S. government's creditworthiness wavers, it could cause market volatility, prompting investors to seek safer or more profitable alternatives. Such shifts could destabilize markets, causing ripple effects in stock prices, currency valuations, and international trade. The interconnectedness of today's global economy means that what happens in Washington can quickly reverberate around the world. This looming uncertainty feeds into fears about a potential financial crisis or recession, while a credit downgrade itself does not cause a crisis. It often reflects underlying economic challenges that, if unaddressed, could spiral into deeper problems. The higher costs of borrowing can constrain government spending on crucial services and investments, slow economic growth, and erode public trust. Consumers and businesses, sensing trouble ahead, may reduce spending or investment, further slowing the economy. The possibility that the U.S. could enter a period of economic stagnation or contraction is a real concern among economists and policymakers, especially when combined with other pressures like inflation and geopolitical tensions. Yet, it's important to remember that this situation is not set in stone. While the challenges are serious, they are not insurmountable. The United States has faced fiscal crises before and has always found ways to recover and strengthen its economy. The key lies in taking proactive steps to restore fiscal discipline, rebuild trust, and demonstrate to rating agencies and investors alike that the government is serious about managing its finances responsibly. Preventing a financial crisis requires bold leadership and cooperation. It means lawmakers setting aside partisan differences to tackle the root causes of the debt and deficit. Fiscal reforms must be put in place that balance the need for government programs with the imperative to keep spending sustainable. This might involve difficult decisions on taxation, entitlement programs, and discretionary spending. Transparent communication and long-term planning are critical to reassuring markets and citizens that the government is committed to fiscal health. Moreover, it is essential to encourage economic growth, alongside fiscal responsibility. A growing economy generates more tax revenue without raising rates, making it easier to reduce deficits and pay down debt. Investments in infrastructure, education, innovation, and workforce development can create the conditions for sustained growth. At the same time, controlling inflation and ensuring a stable monetary policy will help maintain economic stability. Public engagement and awareness also play a vital role. Citizens need to understand the significance of the debt and credit rating, issues and support policies that promote fiscal sustainability. Without public backing, meaningful reforms become much harder to implement. Educating the public on how fiscal decisions affect their daily lives can build momentum for change. While the downgrade signals a warning, it should also be seen as an opportunity, a catalyst for reassessment and reform. It challenges leaders and citizens to prioritize long-term economic health over short-term gains and political convenience. The U.S. has the resources, talent, and resilience to turn this moment around, but it requires commitment and decisive action. In closing, the Moody's downgrade is a clear signal that America's financial management is at a crossroads. The path forward will not be easy, but with determined leadership and collective will, the U.S. can restore confidence, stabilize its economy, and secure a prosperous future for generations to come.